You built this business. You probably have a finance function, someone running the numbers, sending reports, and building the dashboards. But yet every month, you have that feeling. Revenue is there, the team is busy, but margins are thinner than they should be. The cash position is tighter than it should be, and you can't put your finger on why. But here's what I've learned after 30 years of working in the industry, including time at some of the world's largest professional services businesses. The numbers you're being shown are not the full picture. Not because anyone's hiding anything, but because the way that professional services firms measure themselves is fundamentally incomplete. And that gap between what the reports say and what's really happening is costing you money every month. In this video, I'm going to walk you through the four numbers that most finance teams don't surface. I'll show you where the gap lives, why it matters, and what typically costs firms at your size to leave it unaddressed. If you run a professional services firm, an agency, a consultancy, an architecture or PR practice with up to 200 employees, this is going to be directly relevant to your situation. My name is Mike Hiley. I'm a chartered accountant, and I've spent 30 years working inside and alongside professional services businesses, from small independent firms to divisions inside organizations like WPP and Kantar. I now run the profit and capacity diagnostic for professional services firms that know something is wrong but can't identify exactly what it is. What I'm going to share with you today is what I see again and again when we go inside these businesses. These are not theoretical problems. They're consistent, structural, and most importantly, they're completely fixable. Most finance reporting in professional services is built around revenue. Revenue by client, by month, revenue versus budget. Revenue is important, but on its own, it tells you nothing about whether you're running a profitable business. Here are four numbers that actually determine whether money is being made or lost, and what most finance functions don't track or don't surface clearly to leadership. Number one is profit level margin. Profit margin, the profit or loss on each individual engagement. All firms know their top line revenue, and some will have a client or departmental view, but surprisingly few know whether that revenue was profitable once you account for actual delivery effort, rework, scope absorption, and overhead allocation. This matters because the client that looks like your best relationship is often not your best performer on margin. Revenue is real, but the profit frequently is not. I'm not going to fabricate a number for you here, but I will tell you this. In virtually every single engagement we run, at least one of the firm's top 5 clients by revenue is either break even or negative margin. That's not an exception, it's a pattern. Number two is the realization rate. I talk about this in every video because it's fundamentally important. Utilization is the metric that most firms watch. Your team is at 85% utilization, and that sounds really great. But realization is different. Realization measures how much of that billable time actually converts into billed and collected revenue. A team member logs 12 hours on a client project. 4 of those hours are rework, 2 are scope that was never contracted. The client is billed for 6, and you collect 5. Your utilization might say 100%, but your realization is something very, very different. Realization gaps are one of the most reliable indicators of hidden margin erosion in professional services. Most firms don't track it. Their finance function doesn't surface it, so leadership never sees it. And number 3 is the cost of non-billable senior time. As professional services firms grow, their senior people spend more and more time on activities that don't bill. Business development, internal management, fixing delivery problems, client relationships that don't have a project attached. This is entirely normal, and to a point actually necessary. But the problem is when it's invisible. If a senior person is billing at your firm's standard rate for 60% of their time and spending 40% on non-billable work, the cost of that 40% has to be absorbed somewhere. In most firms, it just gets lumped in and absorbed as overhead. And that overhead gets spread across all the projects. That means your project margin calculations are understated and your profitability by client is wrong. And number 4 is the cost of mismatched capacity. I want to address something with you directly. If you've watched more than one of my videos on this channel, you've heard me talk about senior people doing junior work. And I make no apology for coming back to it. It comes up in every diagnostic we run. And in my experience, it's one of the most consequential and consistently underestimated margin problems in professional services, and it deserves to be on the list. The pattern is this. A senior person, director, principal, or senior manager, is regularly logging hours on tasks that should be handled by somebody 2 grades below them. The work gets done, the project moves forward, but you are deploying a resource at a rate that doesn't match the value that's being performed. If the client is being billed at the senior rate, it's hard to justify to a commercially aware client. If the client is paying at the lower or a fixed rate, the cost of that misalignment sits entirely with you. Either way, the margin on that project is being quietly eroded by a staffing decision that no one made deliberately. It just drifted into place over time. This is visible in timesheet and project data. When we run the diagnostic, we cross-reference who is logging time against what, at what rate, and whether that matches the planned staffing model for the engagement. The misalignment shows up quickly, and the cumulative cost across the portfolio of clients is always larger than leadership expects. I want to be clear about something though before we go further. This is not a criticism of your finance function. The people running your numbers are almost certainly doing exactly what they were hired to do. The problem is structural. Professional services businesses are notoriously difficult to measure accurately. Your revenue is often deferred or recognized in ways that don't match your cost patterns. Your cost base is almost entirely human, and human effort is imprecise. Your timesheets, if you use them, capture what your people think they did, not always what they did do. Your project management tools record what was planned, but not always what was delivered. So by the time the data gets to your finance team, it's already passed through multiple layers of approximation. Finance does what it can with what arrives. The reports get produced, the board pack goes out, and leadership makes decisions. But the picture is incomplete. Not wrong exactly, but incomplete. In a professional services firm where margins operate in a narrow band, typically between 15 and 25%, incomplete is expensive. The gap between what your reports say and what's actually happening is not static. It compounds every month. Every month you're making decisions, staffing decisions, client investment decisions, based on a partial picture. Every one of those decisions that turns out to be wrong costs you something. And the longer the gap persists, the more it costs. It's not a one-off cost, it's a monthly overhead. Let me tell you what changes when a firm gets a clear view of all four of these numbers. First, pricing discipline improves. When you can see which projects and which client relationships are margin positive and which ones aren't, you stop pricing on instinct and you start pricing on evidence. Rate card decisions become defensible. Scope decisions become grounded. The conversation with the client shifts. Second, resource allocation becomes intentional. When you can see where your senior time is going and what it's costing, you can make deliberate decisions about where to direct it. You stop relying on team leads to self-report and start having the visibility to manage capacity as a strategic asset. Third, the decisions that have been sitting on your desk start to move. Should you renew that client relationship? Should you hire or reassign? Should you take on that project or proposed fee? These questions become answerable. Not certain, but answerable, based on the data rather than your instinct. Fourth, and perhaps most importantly, you stop subsidizing the wrong clients with your best people. Every professional services firm has clients that consume disproportionate delivery effort relative to the revenue they generate. It's not usually visible until somebody goes to look into it. And when it becomes visible, it changes the commercial conversation immediately. None of this requires new technology. None of it requires a system overhaul. It just requires assembling the data you already have. Your finance data, your time data, your project records, and then cross-referencing it all properly. That's what we do in our profit and capacity diagnostic. It takes 4 weeks. We work with you with what you have. We surface the picture that currently isn't visible to leadership, and we build you a 12-month plan that shows you what to fix first and in what order. I want to say this plainly because it's something that most people don't say in this kind of video. Delay has a cost, a financial cost. If your firm has a revenue of $10 million and your margins are running 5 points below where they should be, that's $500,000 a year. Not in theory, in real money that should be in your bottom line. Every month that picture stays unclear is another month of decisions made on incomplete information, another month of cross-subsidization, another month of pricing that doesn't reflect the true cost, another month of capacity deployed in the wrong places. Most founders I speak to know something's off. They've known it for a while, and the reason they haven't acted isn't that they don't care, it's that they can't quite see it clearly enough to know where to start. That's exactly what the diagnostic is designed to address. Not more information, but clarity on the right information. By the end of week 2, you will be able to see which clients and projects are pulling their weight and which ones aren't. And if at that point you don't see insight worth multiples of the engagement fee, you stop and you owe nothing further. That's the guarantee. I started this video by talking about the feeling. Revenue's there, team's busy, but something doesn't add up. That feeling is data. It's telling you the picture you've been shown and the picture that's actually there are not the same. You built this business and you deserve to see it clearly. 30 years of working inside businesses like yours has taught me one thing above almost anything else. The firms that pull ahead of their competitors are not always the ones with the best services or the biggest teams. It's the ones who can see their business more clearly than everyone else and make better decisions as a result. That clarity is available to you. It doesn't take months, it just takes a matter of weeks. If anything of what I've described in this video resonates, and you have the feeling that the numbers you're seeing don't fully explain your business, the next step is a 20-minute profit and capacity briefing. It's a working conversation. We'll look at your specific situation, identify where the gaps are most likely to be, and confirm whether the diagnostic is the right fit for you. If it's not, we'll tell you straight away. We run a limited number of diagnostics each month, so slots are not unlimited. But if the timing is right, let's use 20 minutes to find out whether there's a real opportunity here for your business. I'll see you there.